Hi! So I just wanted to provide an interim update to all of you who are busybodies and also maybe expound on a few interesting observations that nobody seemed to be talking about. Probably because it's regarding Chinese equities and it doesn't really look cool to be investing in a quote-unquote communist country. So for those of you who are unaware, I share my portfolio publicly, I don't sell causes or anything, and I manage my own money. So I don't have pressures from the public to outperform any sort of benchmarks at all. At the very most, I just get more people laughing at me. That's about it. But I'm not too sure how many people can still laugh after the recent meltdown of the entire stock market. But you can stop the like button from laughing by smashing on it. You know the drill. Oh, and one more thing. Not sponsored by the way, but I know many of you out there probably have not maxed out all the available sign-up rewards. Currently, stockbrokers like Tiger, Moomoo, and even Weibo have extremely aggressive sign-up campaigns that gives you essentially risk-free return. Where can you get something like that? Moomoo and Tiger Brokers is giving out cash coupons and even free shares, and if you're lucky, you can get a free Tesla stock. While Weibo on the other hand is giving out $100 worth of Apple shares. And you shouldn't allow all these 100% ROI deals get away. I'll leave the link to all these brokerages in the description box down below. Anyway, 6 weeks ago, I posted this video on the 9th of May 2022, titling My Negative 35% Alibaba Portfolio. It seemed to have gotten quite a bit of traction, and I even saw people even tagging my videos on different forums. Interesting. How can I just stop there? So to cut to the chase, 6 weeks later, the portfolio is currently down negative 24%. Yes, it went from negative 35 to negative 24. Why? I don't know. But in that same period, the S&P 500 was actually down for another 8%. Interesting world we are living in, isn't it? So I'm not bragging by any means, by the way. Besides, what is there to even brag when I'm still down by such a huge margin? So there has also been some new additions in my portfolio that I wish to update you guys in the name of transparency. So first, of course, I have added new funds to it because ultimately I needed to abide by my initial dollar cost averaging strategy. So for newcomers, I have committed to adding $600 to $700 every month at the end of the month into KWEB, which is essentially a Chinese tech ETF by Crane Shares, and also $250 every month into VT, which is Vanguard's Total World Index. So on top of that, I have also recently slightly increased my exposure to Facebook by around 50%. Yes, I know, I didn't follow the initial strategy that I laid out in the previous video. I did say that I wanted to double my exposure when Facebook touches 160, and it actually did in the past week. However, given how things are playing out currently in the current macro climate, emotions got the better of me and I decided to slow down my averaging. Hence, I decided to buy a little earlier before 160 and also reduce the quantum so that I can just slowly nibble at all these different prices that the market wished to offer. So you see, let's not kid ourselves. As human beings, we are all equally emotional. We might have sound plans going into the market, but when the market throws us a curveball, we will all get affected. So I will continue buying if Facebook continues collapsing. I'm excited, but I just don't know how long drawn this process will be. And I'm not expecting a V-shaped bounce so quickly or so soon. So on top of that, I've also recently started a really small position in Amazon, only $100 worth, just to get my feet wet. It's essentially just to get myself emotionally vested so that I will dig deeper into the company itself. So I've yet to decide whether I wanted to make Amazon a core position or not. I'll update you guys along the way. Now, I know that some of you might be actually wondering that I have cheated because I've added fresh funds into the portfolio, which essentially quote-unquote skewed the performance. So if you were to actually tabulate all the additional funds that I've put in, I added around 2,000 over the last 6 weeks. So if I were to remove the additional 2K that I added into the last 6 weeks, the portfolio would still be negative 36%, much better than the previous negative 35%. So the big question is, why? Simply put, because the huge part of this portfolio is concentrated into Alibaba and also an inclination towards Chinese equities exposure, if they recover, this portfolio will automatically recover in lockstep. Compared to the previous update, Alibaba is up by more than 10%, which explains the quote-unquote outperformance, if you can even put it that way. However, if you're to judge purely based on my Alibaba position, it's still down by 30%. But because I have some sort of other stocks and other indexes, it helped cushion the damage a little. And of course, if the end IPO rumors were true, it would have led to vastly different results. But oh wells. Anyway, this then brings home the concept of diversification. Clearly, my portfolio is hardly considered diversified. So the price you have to pay for concentrating your portfolio is the huge volatility swings you have to go through during each drawdowns. So let's not forget, Alibaba was once trading at $73. That would mean that I'm more than 50% down on my position at its lowest. So I've shelled nearly 50k for this portfolio, so at its lowest, I'm down by more than 20k USD. Was I affected? Probably a little bit, but it helps that I'm investing money I don't really need. So I'm not constantly worried about trying to pull funds out of the portfolio. So don't you worry for me, I was able to sleep pretty well at night. So the market might very well tank another 50% from here, and that would definitely be training my temperament as an investor. Now, I do agree that diversifying is probably the only free lunch in the investing world, but you need to make sure that it actually helps achieve your objective at the end of the day. So my risk tolerance and financial objective will be vastly different from yours. So just an advice, just watch my videos for entertainment purposes, have a good laugh at how much I've lost, and then stick to your own investment strategy. Also, I just wanted to quickly address this idea about dollar cost averaging. Given the current conditions and climates of investing, there are more and more voices online telling you to stop buying, wait at the sidelines for a while, maybe even floating the idea that, hey, maybe you want to sell first and then buy in later. So I'll just say this, DCA is called dollar cost averaging, not dollar cost later. The fundamental construct of DCA is to remove the element of timing the market. So regardless of whether is it a weekly buy, monthly buy, or even a quarterly buy, if in good times you are telling me that, hey, you'll buy every month, and suddenly in bad times because you have talks about recession, inflation, stagflation, high oil prices, wars, etc., and then you stop doing your DCA, then doesn't it destroy the entire premise of a DCA strategy? Then you might as well be timing the market and don't stick to a dollar cost averaging. Sounds ironic, doesn't it? So I just hope that I provide some timely perspective, especially for those of you who have been flirting with the idea of stopping your dollar cost averaging for the upcoming months or so. So I'm talking to those that are generally indexing, by the way, regardless of whether is it the SPY, the QQQ, Hang Seng Index, Straits Time Index for that matter. So for those of you who are picking stocks, timing the entry and size is a given. DCA might not result in good outcomes even in the long term, especially if you pick the wrong company. So that's a given. Henceforth, regardless of how bad the market outlook is, KWEB and VT is a buy for myself every single month. Now, another interesting observation of this supposed quote-unquote decoupling between the China and the US. So if you were to plot the major indexes against each other, the SPY, which is S&P 500, is down 23% year to date. QQQ, which is the Nasdaq, is down 31% year to date. KWEB, which comprises of majority Chinese tech, is down 13% year to date, and the Hang Seng Index, which is the Hong Kong Index, is down 9% year to date, and the Shanghai Stock Exchange Index is down 10% year to date. Funny, isn't it? But of course, this is just purely pitching them against their year-to-date performances. If we were to zoom out on a 5-year horizon, these Chinese-related indexes do look very much like a joke. So we are only halfway into the year, and who knows what will happen in the second half of the year. As the saying goes, every dog has its day. And even though Chinese equities were just laughing stocks for the whole of the last 12 to 15 months, I experienced it firsthand, by the way. Those same voices probably has their laughter muted down by a few notches. Of course, I know that this would not be long, because US equities will definitely have its glory days again. But I think the bigger lesson here is to strive for equanimity. Don't get overzealous when you're up, and don't get too caught up when you're severely underperforming. The focus has been and should always be on improving your investing craft. What lessons have you distilled in the process, and how do you better your framework in the long run so that you can continuously replicate the same successes in your subsequent opportunities and your subsequent investments? Would China come out of this bear market earlier than everyone else? Who knows, but diversifying out a little probably wouldn't kill. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!